Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to Merryn Talks Money, the podcast in which people who know the markets explain the markets. I'm John Stepek, senior reporter for Bloomberg and author of the Money Distilled newsletter. Today I'll be covering for Merryn in this special episode of the show, recorded live from the Edelman Smithfield Investor Summit at the London Stock Exchange. With me is Dr. Gerard Lyons, one of the UK's most prominent economists. He's an expert in the UK economy, emerging markets and global trends. Gerard is also chief economist at NetWealth, having taken up the position in 2016. He's also a senior independent director at the Bank of China. He's the chair of the Risk Committee at BGC, which is part of the Cantor Fitzgerald Group, among many other things. Now, clearly given Gerard's focus on the UK economy, I wanted to get his views on a certain recent fiscal event and what he thinks the consequences of the budget might be for the year ahead, both for the UK economy and for asset markets. But we won't just focus on the UK. I'm also keen to get his views on whether we've really seen the back of inflation or whether there might be any nasty surprises on that front or any other fronts in 2026. So Gerard, it's great to have you on Merryn Talks Money. Thanks for coming.
Lovely to be here. Thank you for asking me.
So I was just reading a piece that you wrote in the immediate aftermath of the budget on CapEx, in which you described it as bad. What do you feel was the worst overall element of the budget?
Well, the most disappointing part about the budget is that while all budgets are impacted by a combination of politics, economics and the public finances, usually it's the budget before the election that's dominated by politics. And ever since I've been following budgets, the first and usually the second budgets after elections are driven by the economics and by the public finances, in the sense of the government of the day wants to set out its economic vision. And also usually they want to get the public finances back into shape, often so they can actually spend a bit more money ahead of the next election. But usually the first or second budget after an election is, where's the economic vision? Let's get the finances into shape. We have had neither of those aspects in either last year's budget or this latest budget. In fact, both were driven by politics, shall we say. And so the disappointing thing is there was no economic vision there. The public finances were given some temporary reprieve, but the underlying picture is, the reason I called it bad was I thought it was bad for the economy. I thought it was bad for incentives. And also, despite the near-term positive spin, it was bad for the public finances.
I mean, that's interesting because, I think that, you're right, that usually the first couple of budgets are where we expect to get the hard choices made. And actually, the whole point about this budget was the hard choices were all ducked in favour of preserving, arguably preserving Rachel Reeves and Keir Starmer's kind of careers for now. So whenever you're saying about the public finances still being at risk, because obviously gilts markets have seem to have calmed down. We started the year with everyone panicking or worrying that bond markets generally, not just here, but in the US as well, were going to revolt. And so far that hasn't happened.
Yeah, let me answer that in two bits. First, let me say why I think the finances are in bad shape. Then I'll come on to the market reaction to the budget. The UK is a low growth, low productivity, low wage economy. But alongside that, we've become a high public spending, high taxation and high borrowing economy. And this budget has not addressed any of those issues. Public spending continues to rise. A year ago, taxes went up by £69 billion. In this budget, they went up by £26 billion. Now, there was this magical reduction in borrowing 4 years out. Now, we have a farcical fiscal process in the UK. We're all sitting here talking about the budget, and all these numbers refer to fiscal rules that are self-imposed that apply in 4 years' time. The margin of error on a 1 year ahead economic forecast is high, and the margin of error on public finances, difference between government spending and revenue, given the large numbers involved, that margin of error is equally high. So we have this situation where we have best guesses about 4 years down the line of fiscal rules that set things. But the Chancellor unveiled front-loaded spending increases, particularly next 3 years, then back-loaded tax increases that hit very hard, particularly stealth taxes, but there was a combination of taxes. And in the final year, there's this fall in the borrowing requirement. But the reality is that that's unlikely to occur because public spending will likely be rising as we head into the next election. In fact, I think Britain is heading for a debt trap by the end of this decade. A debt trap is when your level of debt is above 100% of GDP, and when your rate of economic growth is less than the rate of interest you're paying on your debt. You then basically have to run what's called a primary surplus, a surplus where you take out interest payments and you have to run a primary surplus just to stand still. We haven't run that many surpluses. In fact, if you take wider surpluses, the big picture stuff, we've only run 7 budget surpluses since 1969. So the fiscal numbers are not being addressed. Spending is still rising. Can you believe this? The Centre of Policy Studies, who I'm associated with, a few weeks ago, did an analysis from 1990 to 2019, the year before the pandemic. We've had 54 medium-term spending plans in the UK. And in every single case, 54 out of 54, spending has exceeded expectations. Never once have, regardless who's in power, never once have we come in below those targets. And those targets aren't particularly hard pressing. They allow a lot of room to spend money. So the reality is spending's going up, taxes unfortunately would go up, and borrowing's still pretty high. Now, coming onto the market, you're right, the bond market's reacted.
Because the obvious question here is, like, they get lied to every time. So what is it? Are the gilts markets just daft? It's like, why don't they get this?
Well, it comes down to expectations management. The worst thing about this budget, apart from what was announced, was the shenanigans in the 2-3 weeks beforehand.
Yes.
Now, the OBR mistake, obviously, they've taken responsibility for that. That shouldn't have happened. But also, pre-budget purdah should be restored. Obviously, you cannot stop rumours, but normally you have this period of silence before the budget. We had deliberate kite-flying, misleading messages. Now, that didn't help. I don't think it helped economic or business confidence. The outlook for any economy is in the interaction between the fundamentals, policy and confidence, and we can never predict confidence. But confidence was such that people basically stopped doing things. Yeah. Savings ratio has picked up. But people stopped spending. Companies decided to wait and see. So I don't think that helped the economy in the run-up to the budget. But coming back to your question about the markets reacted in a neutral to positive way, I would say for 4 reasons, but 2 key ones. The first key one was that the fiscal black hole or the fiscal gap, however it was being described, but people called it the black hole, that was less bad than feared. Yeah. So in that respect, the Chancellor managed expectations. Some people have used other words in recent weeks to describe that. So the fiscal black hole was not as bad as expected. And second, very importantly, the fiscal headroom was rebuilt. Now, the headroom is the buffer you allowed yourself to meet your main fiscal rule. Jeremy Hunt, her predecessor, Rachel Reeves' predecessor, Hunt had squeezed the buffer down to a very small amount before the election. Foolishly, Reeves kept with that in her first budget, but it was 9.9 billion. We now know it was down to 4 billion before she took any measures. So she's rebuilt the headroom to 21.7 billion pounds. So that lessens the chance of a Groundhog Day situation next year. So the markets reacted both to the fact that the black hole wasn't as bad as feared and the headroom was rebuilt. On top of that, there were 2 other factors. One, the announcement of the gilt sales, whilst it was still high, was marginally less than the markets had feared. A shifting from longer dated, because defined benefit schemes are now not buying really long-dated gilts. So a lot more issuance of short to medium-term gilts, which is what the markets was anticipating. So all that announcement was well received. And then also the takeaway from the budget was that it would lead still to an interest rate cut. So the markets reacted to the gap, the headroom, the issuance news, and also the expectation that the Bank of England would still be able to cut interest rates in December.
Well, actually, so moving on to the Bank of England, because this does feel as though Rachel Reeves, because obviously she also leaned against inflation in quite an artificial way by kind of changing energy bills, that sort of thing.
You know who tried to do that? Diocletian in the year 301, I think. He said, inflation is too high, so let's control the price of vegetables.
Did that work out well for him?
Yeah, when you have a modern-day chancellor think they can artificially keep inflation down, it is artificial, let's be clear.
I mean, it definitely smacks of trying to game the system slightly. Yes. But in terms of the Bank of England's role in all of this, actually generally, because obviously there's been talk about how the Bank of England should have been more careful with quantitative tightening, how the Bank of England, has its management of interest rate policy been as on the ball as it should have been? And I'm just curious to get your kind of take on that. I mean, do you think interest rates are heading down next year?
Okay, interest rates are heading down. I'll come back, if I may, on the Bank of England, because I think they've done a terrible job. But in terms of interest rates, I think they will trend down. Look, a rate cut is not guaranteed in December. The vote at the last meeting was 5-4 not to change. And when one saw the individual paragraphs on the different members' voting decisions, there are some entrenched views there. Inflation is sticky. So those people against cutting rates will probably find reason not to cut. But I think there will be a cut in December. Rates, I think, will trend down next year. Now, one of the big factors that the markets are not taking on board, I think, is the involution effect in China. Involution is the key buzzword in China. I've just come back from 2 weeks in China. Yeah. China is in such a competitive position. Its export sector is phenomenal. Its quality car production is incredible. And at the same time as having real value for money production, the Chinese currency is moving with the dollar. It's definitely not pegged, but it's moving with the dollar. So the dollar is depreciating. The dollar has been hit by passive diversification. International investors are not actively selling US assets. They're putting less of their net new money into the States. So the dollar is weakening. The Chinese currency linked to the dollar indirectly is weakening. So Chinese goods are incredibly competitive. And I think there will be a swathe of Chinese exports coming to Western Europe. It will really compromise, to be polite, the European auto industry. But in the UK, we will see a real positive impact from this in disinflationary effect.
This is basically a wave of deflation coming back out
disinflation,
China
deflation,
again.
you might say in
disinflation.
The auto industry, definitely. Yeah. And so I think that factor hasn't been factored in to expectations.
And just just to pick up one thing quick. So involution, this is where companies are so competitive that they're basically not making any money at all in China.
They're so competitive, it's so cutthroat. And it's been an issue since June of last year in China, June 24. And so we've had a year of this in China. So you have close to deflation in China. Yeah. China's still, as an economy, doing well, but it's at cutting edge on AI, manufacturing. The UK still has quality high-end manufacturing, but we're suffering from energy policy, etc. But bottom line is, for the Bank of England, I think interest rates next year will go down to 3.5% by the spring. And I would say the base will be 3% by the end of next year.
Oh, okay.
I would like to see interest rates eventually settle nearer 3.5%, but I think interest rates will undershoot what I think would be their norm next year. Now, the bank, like the Fed, is very cautious in terms of cutting rates. That gradualism is understandable when you look at sticky inflation and how that has been in the service sector. But I think the trend for rates will be down in the UK. But you asked a wider question about the bank. A couple of weeks ago, there was a letter from the governor to the chancellor. I was surprised it didn't receive a bigger media pickup because in it, the governor said QE was an unbridled success, which is complete nonsense. He then said quantitative tightening is a technical exercise and did not justify the selling of gilts now as opposed to letting the gilts mature. So wrong on that as well. So 2 wrong so far. And also defending the payment of bank rate on full commercial bank reserves at the Bank of England, which gave the Chancellor some ammunition to not change this policy. And again, wrong on that, because the payment of full bank rate is not necessary for monetary policy. It costs the taxpayer money. The European Central Bank, for instance, has a tiered system that allows it to actually not pay full bank rate and allow monetary policy to work properly. QE, quite frankly, has gone through, it's a bit like interest rates. You have to look at QE in the context of the economic environment. Yeah. And we've had 3 stages of QE, the good, the unnecessary, and the bad. The good after the global financial crisis, when it was justified. Then the complete unnecessary QE and cheap money for 10 to 12 years, when it led to asset price inflation, led markets to not price properly for risk, led to a misallocation of capital, led to zombie firms remaining in business, led to growth firms being denied access to that capital, and it fed the inflation we saw. To describe any aspect of that as good is complete nonsense. And then we had the bad QE policy after the pandemic, when it was, what did we do the last time there was a crisis? Oh, we had QE, without recognizing that the QE after the global pandemic was wrong and compared to the QE after the global financial crisis. So I think question marks have to be continued to be raised about monetary policy, but we only ever judge monetary policy in terms of base rate, it seems. But the markets very much will be focused on that base rate aspect and the wider quantitative tightening impact and the impact that has on the yield curve as well.
You're right. I did notice that later, and I did think it was kind of strong for him to say that, over the course of QE and QT, it's all going to basically net out and be profitable. And you're kind of, but wait a minute, we've already had the bit where the government took the money out from QE, and now the taxpayers having to pay that back. So having to kind of netting it out like that, it doesn't really work for taxpayers today. Because we weren't actually really given the option of putting the money in a savings account for the future, 10 years ago or whenever it was that George Osborne kind of changed the accounting for QE. I did think that was an interesting way to look at it.
Absolutely. In one respect, it leads into a wider debate about the relationship between the central bank and government, because this has always been a grey area in terms of QE and the fact that we haven't really sort of examined all the pros and cons of it. But it's very relevant in the States at the moment, where there's a debate being held in public about the roles and responsibility of the Fed ahead of the likely change of the head of the Fed next year.
What is your view on central bank independence? Because obviously it's always promoted as being the thing that created the stability of the last of the first 10 years of the millennium, basically. And I mean, that's always struck me as just this convenient timing rather than anything else.
Well, in modern day terms, one of the challenges is that central banks are not held to as much account as they should be. Yeah. Certainly here in the UK. There was the Lord Forsyth House of Lords Economic Affairs Committee report a couple of years ago, which was quite devastating on the Bank of England. That was an exception. Then we had the Bernanke report last year, which was also pretty devastating. Now, given what was raised in the Bernanke report, I would have hoped that the central bank would be more under the spotlight than it is. But we have this situation in the UK where any criticism of the bank is regarded as an attack on its independence or integrity, when what it really is a challenge to its competence and its credibility.
Yeah, so demanding accountability is not the same thing as undermining independence.
A year before the Bank of England was made independent in 1997, there was a report by a very famous economist, Barrow, in the Bank of England Quarterly Bulletin, which examined central bank independence. And it concluded that central bank independence did not guarantee low inflation. It said actually it's normally a third factor, something outside of the bank's control. And you could say in the first 20 years of central bank independence, as was the joke in the city, it has to be said, it was an external factor. I say the joke in the city because for many years the city said the CPI, Consumer Price Index, should be renamed the China Price Index because it was international factors. Yeah. Now, coming back to independence, once you have an independent institution, to take away that independence, as we're seeing in terms of how the markets are reacting to the debate about the Fed, sends too many negative signals, etc. So what you really want to do is retain that independence, but to have more accountability and better examination of the issues. Central bank independence was not everything it was made out to be, but to reverse it is dangerous and damaging. But what you can actually do, certainly here in the UK in the wake of the budget, you can use it as an example of how we should be re-examining how these institutions can do their job better. And indeed, if I may, like here in the UK, I quite like the OBR. There was an external review of the OBR earlier this year. It was the third 5-year review of the OBR. Again, didn't receive much press coverage. Bloomberg yourselves covered it in February. It was Dutch experts. And it said you need to move away from an obsessive focus on fiscal headroom to focus on medium-term fiscal numbers. I think that's important because if you focus on the headroom for all the problems it entails, you immediately focus on taxes because that's the lever you can pull.
Yeah.
When you start to move to medium-term forecast, politicians ignore it because they're not thinking beyond the next 5 years, which is disappointing, because the OBR says that the UK's medium-term fiscal numbers suggest debt is heading to 270% of GDP, 270%. Once you move away from fiscal headroom and taxes and focus on the medium term, you then focus on the thing you have to get under control, which is public spending. So all of these issues is make the bank do a better job, keep it independent, use the OBR but in a different way, and start to reframe this policy debate. So we do use experts, but we do have political accountability. And what we're trying to achieve is an economy that does better rather than just ticking short-term boxes.
Well, I look forward to that happening once a horrendous crisis actually forces us to do it. But look, so obviously none of that is terribly happy sounding. But for our readers, they're sort of thinking, well, what actually, not our readers, our listeners, getting a bad habit, too many years of editing a magazine. What do you think is the outlook for UK companies and for UK markets this year? You know, it's because, as I say, this doesn't sound great for the wider economy.
One of the positives in terms of the companies is that when one asks firms about their own situation, they tend to be quite upbeat. So there's quite a divergence between what firms say about their own balance sheets and position versus what they think about the economy. Now, in the past, it's usually been the case that what firms have said about their own situation, which has been the better predictor of what is to come. So that should give us some confidence. Obviously, it varies across the boards. Small firms are 99.8% of the economy, but they're not the dominant players in the market. Obviously, the FTSE 100 is very much driven by international factors. The banking sector came out of the budget very well. That's the important factor. And so the global picture is one of modest growth. The UK economic picture is one of modest growth. The OBR's forecast for the year ahead is 1.5%. Market consensus is probably closer to 1%. So it's modest growth. The savings ratio is quite high. So people have the ability to dip into their savings if they want to. So in terms of investment, I don't think the budget itself set down the good benchmark as we were touching on, but the prospects for interest rates is quite key here. And if interest rates trend down, then I think that will be a positive development. At Net Wealth, we very much talk about the need to be globally diversified. Given the unpredictability of US policy, the uncertainty globally, a key thing in the year ahead is liquidity. Whichever investments you go for, you need to be thinking of liquid, not illiquid investments. The growth of private markets is a big development in the year ahead. People are going into crypto and other assets. Bear in mind that a consequence of unpredictability in policy is high volatility. So again, one needs to be cognizant of that feature. But overall, I'm not negative. I would highlight the fact that the picture itself, both in terms of growth and markets, is far more nuanced. And if you decide to be more risk averse, then it's important to bear in mind that not all risk averse type assets react in the same way to all risks. By that, I mean, you need to be very clear why you are buying a particular asset class. And so overall, I would still be as invested as possible. I would be diversified and I would be very global in one's outlook.
That's an interesting point because it's actually been a pretty spectacular year for markets this year, which again, given all the gloom over politics in general, sort of like felt a bit intuitive, but I was looking at the numbers and like the FTSE 100's like up with its best year since 2009. Plenty of the other global markets. In fact, the US is the laggard this year for the first time in a long time. And I'm just wondering, do you think Will this trend of the rest of the world catching up continue next year, or do you think that this was a one-off?
Yeah, we had a great year at net wealth, and it's reflecting all those different moving parts. Yeah, it's not that the risks and the downsides are not important, but if you pin everything onto those, you can get caught out by other factors. Volatility is there. There's no doubt about that. That's reflected in the gold price, for instance, but it was not just cheaper in terms of price, but cheaper in terms of where real yields were a few years ago to be buying gold than it is now. So the point is that you need to look at all these factors. But coming back to your specific question, what we have is Western Europe, unfortunately, is the slow growth region of the world economy. The Draghi report from September 2024 talked about the innovation gap. The first anniversary of the Draghi report a couple of months ago showed that only 11.2% of the recommendations had been executed.
A whole 11.2%? Yeah, that's really specific. I'm quite impressed. I want to know how they managed to get the 0.2. Yes. What measure was that?
Exactly, because I kept thinking, what they need to focus on is a mindset change. That's what you need to move away from that. So Western Europe is in a difficult position. I think that turn the atlas around is my point. And I've been saying this for a number of years now. So you need to look at the world with the Indo-Pacific, with India on your left, America on your right, and you look at where the growth engines are. So it's about UK companies positioning themselves within this and the UK economy itself. But coming back to your question, the global environment, I think, is still an attractive one. But put this in perspective, the IMF is a good benchmark for global growth forecasts. And they expect global growth in 2026 to just be above 3%, as it was in 2025. Now, trouble is we've become used to these growth rates. Before the global financial crisis, that global growth rate on the IMF measure was around 4.5%. So we have a significant slowdown, but more of that growth is coming from other parts of the world than the UK and Western Europe. So therefore, we do need to be thinking in a very international way.
And is there anywhere in particular that stands out to you as being attractive for next year?
In terms of the global picture?
Any regions that, you'd probably want to weight more towards or anything like that?
Yeah, you need to be thinking structurally a longer term. Take, for instance, India's growth rate is the highest globally, but it should be far higher than it is now, given its population dynamics. But in answer to your question, it's that Indo-Pacific region, but particularly East Asia looks pretty dynamic itself. The Chinese economy have their 15th five-year plan. Obviously, there's issues about where one invests in China, but East Asia is generally a strong positive. But then let's come back to the dynamic sector, AI. Now, on the global comparisons for AI, whether you use Stanford University or the Australians are pretty good with their global measures, there's two countries that dominate, China and America. And if we were using a football analogy, we would go from the Premier League down to the Championship to League One, and then we get the third country, which is Britain, i.e. we're in the pretty good position, but let's not kill ourselves. Those two countries are so far ahead. But the important point in terms of your question about investment is that America and the Magnificent Seven, their balance sheets are pretty good, and they are investing heavily in capital investment. That will help the US economy, but the challenge is the markets have almost fully discounted a lot of that news. But when you look at the earnings expectations in the US market, there's such a difference between that Magnificent Seven and the rest of the economy in the States. So it's again, to use the word nuanced, it's not a case of just picking one country or one region. You need to sort of differentiate between those factors.
On that, are you worried about an AI bubble? Do you have a view on this? Do you have a sense of whether there's a kind of .com type bust coming at some point whether it's next year or a couple of years hence?
Well, there are always risks out there. The way I would answer the question is this. Look at the three big macro moving parts. First, we've got sort of a significant shift globally, globalization to fragmentation, protectionism has now replaced free trade, and home country bias has therefore come to the fore. So, and then a second big factor is that you now have uncertainty, unpredictability in terms of US policy making, that seen in trade policy and institutions. And then you've got that third big sort of factor coming through in terms of geopolitics and geoeconomics. And you basically have supply chains being disrupted. So all of those parts come to answer the question here. There is some underlying strength, but in terms of markets footing pricing for risk, it's often linked to the liquidity cycle.
Yeah.
We've got central banks, their balance sheets have been shrunk, but there is still sufficient liquidity driving these markets. Next year, we'll see the growth of private markets, the growth of crypto. But in answer to your question, I think markets are not fully pricing in the risk, but that doesn't mean these markets are about to adjust tomorrow. I still think if rates are trending lower, the answer to this question becomes more apparent as you end the interest rate easing cycle, or as you approach the end of the interest rate.
So as long as rates are heading down, you've got that.
As long as there's economic growth and rates are heading down. Earlier, I talked about the UK heading for a debt crisis later this decade. Unfortunately, that before 6 of the G7 countries later this decade. Markets might start to anticipate that more, but we saw it recently with France being a worry. France and the UK depend more on foreign investors to buy their debt than anyone else. But in answer to your specific question, you never say never, but I think the point I was trying to make was there are enough other structural moving parts that means that question you asked should not just be the dominant question, and you need to answer that question itself within the context of the other moving parts and also the interest rate cycle.
So now I'm going to ask you something that is very simplistic and straightforward, but so like next year, what is the one thing you'd be most worried about that could derail the fun that we've been having this year, if that's the right word?
Well, the geopolitics is always a concern, and that goes without saying. The unpredictability of policy is a concern. But in macroeconomic terms, it has to be the debt issue.
Yeah. So do you think that could come to the boil next year?
Yeah, in the sense that markets anticipate.
Yeah.
And as we saw in France a couple of months ago, the French government found it hard to pass what the markets perceived was necessary legislation on pensions. And that led to not only political but financial problems in France. So in the UK, it could come to the fore. If you had sticky inflation, as I say, I'm expecting that disinflation trend to allow rates to come down. Let's assume a different universe where domestic inflation remains high in the US and in the UK, and suddenly the markets start to think rates are not trending down, that actually they've already hit bottom. And could the next move be up? Obviously,
yes,
the markets are not thinking that, particularly if there's a change in Fed leader coming. But if you started to change perceptions because of sticky inflation, and then that key relationship between not only the level of debt, but relationship between R&G, interest rate and growth, the markets will start to think, well, these issues are mounting. There's no easy get out clause now. Let's anticipate these problems and sort of factor them in now. Crowded trades are a dangerous thing for any investor. Crowded trade is where you all do the same thing because you all think everyone else is doing it, and then you think you can get out quicker. The analogy people used to use, probably some people might think it's a nap analogy, is the idea of someone standing up and saying fire in the middle of a theatre. Everyone rushes to get out the emergency exit at the same time. So the idea is in the crowded trade, when people run for the exits, they don't do it in an orderly, predictable way. Yeah. And so you need to be sort of very aware of that. So in terms of the debt problem, it encourages investors to start being more cautious sooner. Yeah.
No, okay, that makes a lot of sense. Is there anything else that you wanted to bring up specifically, Gerard, or do you feel we've covered what you were wanting to
because we're here at this Edelman thing, I was just on the panel before and someone asked a really pessimistic question on the UK, as you probably would a week after the UK budgets, which was a disastrous budget, as we said. And they said, is there anything positive to say? So maybe given it's Christmas time, let's try and cheer people up. On the UK, savings ratio is high.
Yep.
Corporate balance sheets are good. Being outside the single market allows the UK to have regulatory autonomy in the area of AI, which is the big growth area of the future.
This is true.
Also gives us regulatory autonomy in the city, the financial markets. We haven't really pulled that lever yet, but the banking sector, as we touched on, came out of the budget relatively well. Being outside the customs union actually allows us to cut trade deals with the fast growth regions of the world. And despite everything, the growth picture for the UK is seen as 1 to 1.5%. And we've discounted, we hope, a lot of the negative news. So maybe there might be some positives on the upside. And also, maybe it's the case, I say maybe, I'm covering myself a lot here, aren't I? The housing market has been stagnant for some time.
Yes.
The mansion tax, which was really a London and southeast of England tax, it was such a stupid tax. Do they not realise how many people work in industries linked to the housing market? I worked at his City Hall for a while, and there were figures used internally about how many tradespeople were working on housing to do up housing. When you start to tax housing, as we know from other countries that have done this, you discourage people from upgrading their property. Yeah. You discourage people from doing them up, and it has a much wider economic impact.
Well, we've already seen that with stamp duty.
That's absolutely. Discourages turnover. Now, maybe the positive, given I was trying to get a positive out of this.
I know, I was thinking, this doesn't sound very happy.
Now, given that we had a lot of uncertainty and given that some of these taxes don't feed in for a few years, maybe we might see some turnover return to this market as well, and that helps things as well.
Well, yeah, because I suppose if interest rates do tick lower, and they have been ticking lower, then mortgage kind of like credit will be available more cheaply and more readily. So you might see a bit of an uplift, although the only problem with house prices going back up is that obviously there are an awful lot of unhappy young people, particularly in London, who that seems to be one of the drivers of political distress rather than...
Yeah. Well, actually, the budget, let's finish on the budget again, because the real golden opportunity in the first or second budget after an election is to try and simplify the system. We have the most complex, and it's particularly relevant to young people as well, in terms of the Manhattan skyline of taxes. We have high marginal tax rates, and the way it used to be described in the Treasury was Manhattan skyline. They go up, and then they go down. Then you earn a bit more money, they go up again. Then suddenly you earn a bit more, they go down. Because if you're a worker with a student loan, you're repaying your student loan, you now have a 9% higher marginal tax rate. Unforgivable. Not only unforgivable, but the Auger report in 2019 to review higher education came out with a recommendation to actually lengthen the time from 25 years to 40 years. I joke to people that if you studied history at university, you could probably cram all your history lessons into 1 month, and you could be repaying a student loan for 40 years on your 1 month of studies. So high marginal tax rates for student, high marginal tax rates then hitting again around £60,000. And if you're lucky enough to have £100,000, high marginal tax rates. But obviously for younger people, I think we haven't done enough to reduce that burden. Yeah. In the early 60s, this was debated about whether students should repay student loan. Obviously, smaller number of people, very different class of people then. But it was decided, why burden them at an early stage in their career with this excessive debt? Obviously, complex issues, but the point is that we need to be doing more to help young people. You need to be building houses. You need to be reducing stamp duty to actually have more mobility. You need to actually lessen their tax burden as well.
Listen, thanks very much for your time, Gerard. Really appreciate you coming along to talk to us about the state of the budget and the UK economy.
It was a great pleasure to be here. Thank you.
Thank you. Thanks for listening to this week's Merryn Talks Money. If you like our show, rate, review and subscribe wherever you listen to podcasts. And keep sending questions or comments to merrynmoney@bloomberg.net. This episode was hosted by me, John Stepek. You can also follow me on Twitter or X. I'm at John_Stepek and Merryn is at Merryn SW. This episode was produced by Summer Sadie and Moses Andarm, sound designed by Blake Maples. Special thanks to Dr. Gerard Lyons, Edelman Smithfield and the London Stock Exchange.